Hey, everybody, Tom Gentile here. Welcome to the podcast. Happy tax week. Uh, did you do what I did? Did you just push it off to August? And then you're going to push it off again to October. Then October rolls around and whatever you got going on, you're going to go ahead and postpone all that and get your taxes done. That's what I do. I'm typically not a procrastinator, but when it comes to that, I kind of have to procrastinate just because of all the other folks that I have to wait on. All those letters that show up that I have to wait on, the tax letters. I got to wait sometimes into summertime anyway. Anyway, how you guys doing today? What's going on out there? I'm doing this podcast middle of the week, and I'm looking at it right now. Markets are selling off. We'll talk about numbers. Earnings are well underway. I want to talk about that, kind of get an idea where the season's going. I'm going to share with you some patterns that about 5 stocks I'm looking at are doing the same thing. And it might not be what you're expecting, but you're listening to this podcast, and I'm going to give you some great information as we get to the end of it. Oh, and God, I hope I can remind myself to tell you about my latest near car accident and somehow what that's got to do with trading, because there's always a story in there and that, hey, this reminds me of that. So I'm going to talk about that as well. The news coming into this week, actually going through this week, S&P 500 heading for its 4th straight loss. NASDAQ drops. NVIDIA's dropping. Gosh. A lot of people think it's the Israel-Iran escalation, and that's what's dragging down stocks. It could be. It could be. Everyone's hoping the situation is going to de-escalate. I mean, if I were, betting on it, and I don't, but if I were betting on it, I'd say that I do think it's going to de-escalate. I think Iran's kind of shown its hand. It's shown its hand, and what else can they do? It's like they threw a bunch of missiles at them and, watched them all pretty much explode in midair. And only to find out later it's because they were all shot down. Oil prices, that's definitely causing a sell-off. But, and 2 more things that I'm going to, get into. The Trump stock, it tanks. It tanked after a massive sale. It was like a garage sale going on there at Trump Media and Technology. I wonder if some of that sale didn't have to be for money that needed to be raised to post bonds. I don't know. You know what? And let me just say this here. I'm not trying to get politically to the left or the right. I really don't care. Ask yourself this question, folks. What president, since you've been alive, for some that's longer than others, what president has directly affected your back pocket, has directly resulted in your successes? Because I can't think of one. I have to look in the mirror if I want to see who's directly affecting my financial future, because it ain't anybody in Washington. I mean, the IRS is directly affecting the net result, but I'm talking about the head in charge. Who's in charge and what are they doing? They're not doing anything. Politicians, the whole politician playbook is push for change, but don't really do anything. And then push for re-election so you can push for change and not really do anything. All right. That's what have I learned in politics? That and Nancy Pelosi is the greatest stock trader in the world. Yeah. All right. Back to the stock market. I mean, you take a look at, Donald Trump stock. That IPO'd. It changed over from DWAC, DWAC, to DJT. That morning, after that happened, DJT opened near $70 a share. Do you know where it was yesterday? 20. I don't even know how low. It was. No, it wasn't 20. It was 23. 23, 22.85. Ugh. Yuck. I mean, wow. If that isn't the beer goggles of any stock, I don't know what is. I mean, I tried to short this thing, and I was shorting it before it was DJT, and I couldn't short it because the stock was impossible to borrow. So I went ahead and wrote call spreads, and what I wrote was the 45.50s. And much to my surprise, the very day after I wrote it, the stock opened at 70. I went, oh, okay, well, that's the great thing about call spreads, bear call spreads. I'm limited to how much I can lose. 2 days later, we were right back down to 45. 3 days after that, those calls were out of the money and making money. Now, where are they at now? Well, unless by miracle DJT gets above 45 in a day or two by the end of the week, then my call spread expires worthless and I keep the credit received. All right. You want to learn more about that? Just check my videos out. I do actual videos, not podcasts, but videos where I go through strategies such as call spreads. All right. But I'm not here to talk about that. I want to talk about the overall markets. I want to talk about what's going on. I mean, take a look at the SPY for a moment. Okay. If you take a look at SPY, what you're going to notice is this. So Dow Jones Industrial Average. I'm actually looking at DIA. All right. So just hear me out here. We're pretty close to where we began the year at. Back down in the high 370s. That's where we were at the beginning of the year. We ran from what, 378 up to about 398. So what is that? About a 5% move. So we were up 5% for the year on the Dow. That was coming into April. April Fools, 5% up. 2 weeks later, we've lost 5%. We're right back to where we started the year at. That's the Dow. The S&P, and I'm looking at SPY. Now, SPY really has, it was trading around 470 at the beginning of the year, went as high as 523. And it's pulled back. It's around 500 right now, roughly. So, but it's still up on the year. We're still up quite a bit for the year, but we are at a pullback. And what's interesting is that 500 level, a really good support level here for you guys that like to step in front of a train. That's SPY. How about the NASDAQ? QQQs? They too started the year out below 400. They ran up as high as almost 450. So, you take a look at that, and what is that? That's a 10, 12.5%. It was a double-digit run to the top. Now we're back. We've given about, 30, given a third of that back. And so still up really nice on the year, but we've hit with the Qs a support level at 427. Another step in front of the, back the train, the truck up move for people that feel the dip is there. It could be a buy the dip moment, right? But here's what makes me a little nervous about these buy the dip moments. You know what's been dipping for quite some time now and really doesn't show any signs of stopping? The bond market. TLT is what I'm looking at when I look at TLT. And I want to kind of take you back in time. So let's go back in time. And I want you to think about a time when we had very, very, very low interest rates. Okay, what were they? 0.25% on the Fed funds rate. You got to go back to pretty much right after COVID. At the time, and hear me out on this, TLT. This is the iShares Barclays Treasury Index, was trading around 170. Okay, 170, and we had no rate cuts back then, or no rate hikes back then. In fact, if anything, we had rate cuts. We were giving away money. You remember those good old days? Those were the roaring 20s, only they were the roaring 2020s. And so as this goes up, as TLT goes up, rates go down. As TLT goes down, rates go up. All right, so I want to fast forward to, let's call it about October of 2023. So October of 2023, this thing was all the way down to 83. We went from 170 down to 83. So that was that was a big drop. Also, that's when interest rates were going up, up and away. And we had thought after that maybe the rate cuts were done, and TLT rose on that news, going back up to 100. Well, since the end of the year, since the beginning of this year, we've done nothing but have lower lows and lower highs. And it's dropped a little, gone up a little, dropped more, gone up a little, dropped more. And you know what? We're back in the 80s again. We're back in the high 80s, but we're back in the 80s again. What does this tell me? It tells me forget about rate cuts for summer. Maybe forget about rate cuts for September. Why would the Fed cut rates when they continue to see the economy, at least on the job end, not falling back like it should? Why would we cut rates when you go to the grocery store and food, agriculture, processed food is still high? It's still high. It hasn't come off. I mean, I'm shopping at Aldi and I'm seeing even prices there. You go to Aldi, you go to Walmart, you go to Kroger, you go to Publix. You're not able to fill your cart on the same amount of money that you used to fill it a year or 2 years ago. To fill the cart costs a lot more money. And I'm telling you, the Fed has to be looking at this, and they've got to be saying the only way we have to stay put. We have to stay put. So you know what? When I see this TLT going down, I think I've got a portion of my long-term account invested in bonds. I was thinking about putting that to work in the stock market. I ain't thinking about it anymore. I'm sitting tight. I'm going to let SGOV continue to pay me every month until I feel better about a potential recession. Because if a recession comes, that's when I want to back up the truck and start putting long-term money to work. All right. What else am I looking at? I'd be remiss if I didn't talk a little bit about oil, the oil markets. You look at USO. USO's back up to year-to-date highs. Yeah, it's fallen off for a little bit, last couple of days. But you look at the highs back in 2023, as we went into September of last year, USO was trading in the low 80s. It pulled back into the end of the year, back down into the 60s. But pretty much this year, it's been up and away as USO has gone from, let's call it $70 a share to well over 80 to 84. So what is that? That's a 14-point move. Oil's up 20% so far, roughly 15-20% the way you gauge it this year. All right. So you take a look at the last few days, however, and we've come back. You would think, and this is logic versus the stock market. Logic says when we're at war, oil goes higher. No, the stock market says coming into war, oil goes higher. But once the missiles start flying, typically oil goes lower, and that's what happened. We've seen a drop off in USO just in the last week. We've seen that 83 drop down into around 78. So we've seen a good few percentage points, 5% pullback in this market this week. All right. I tell you what, you got to give a golf clap. All right. I'm not talking about this because of the Masters, but gold has definitely been a master of assets, as even in the last month. You go back last month, gold was at 200, and that was a resistance number. Do you know 200 is now support as we're trading near 220? 220. We're up 10% on GLD in the last 30 days, last 20 trading days. You want to know where the winners are? The winners are in the shiny yellow metal. How about crypto? What's going on with cryptocurrency? Cryptocurrency has been falling in the last month, in the last week. I mean, you take a look at crypto in the last month, and we're talking about something that was trading over 70. I mean, what were we, 73,000? We hit we went below 60 this week. And so we've had a healthy pullback. And we're in one of the support levels right now for Bitcoin. Bitcoin is in a conservative support level around 60,000. Ethereum, same thing. I mean, the beginning of the year, we had Bitcoin at below 40, went to 73. Now it's pulled back to around 60. I think that's an interesting support level. Ethereum, 2,200 at the beginning of the year, 4,065 last month. We've pulled back on Ethereum to around 2,900, and we've done that this week. That is an aggressive support level. Okay, aggressive meaning it's already gone through two support levels. This is an area where Ethereum needs to hold. And I believe it will. And the reason why is because I think all eyes are on Bitcoin right now because of the halving that's supposed to occur sometime this weekend. And once that happens, I think all the eyes are going to turn off of Bitcoin and they're going to turn to Ethereum as BlackRock eyes that SEC approval for a spot Ethereum ETF. And once they do that, there's 10 other guys waiting to see how that comes out. And they're going to throw their hat in the ring. And then we'll have a dozen ETFs for Ethereum. And that's going to push Ethereum higher. And so that's my expectations there. So that's kind of my idea of markets, what's going on with the markets in a nutshell. Q1 earnings. Q1 earnings are well in force. We got the big players starting to talk next week. I think, when I look, Meta is one that's on my pattern. But, earlier this week, and I'm going to put it up. Where are we at right now in this podcast? 17 minutes. I'm going to put it at the 18-minute mark, guys. All right. 4, 3, 2, 1. Look up on the screen. I know you can't see me, but it's a still image. There's a video link up there to earlier this week. So earlier this week, I put out 10 stocks that were, or 10 symbols that were going through earnings. And we talked about the 7 that were stocks, the 3 that were gold. And if you want some details on that, click on that video and you can check that out. But I updated that for the podcast. And I can tell you there are 10 stocks. I'm gonna highlight a couple of them right now. There's some interesting ones. High implied volatility. Taiwan Semiconductor sitting on its 1-year highs in IV right now. Gilead Resources sitting on its 1-year highs in IV right now. IBM, American Express. All right, those are a couple of others. Crown Castle. All of these stocks, I measure their implied volatility highs and their implied volatility lows, and I look at where they are right now. And here's the thing. Where they are right now is on their 1-year highs. It's not just these stocks. It's a lot of them are on 1-year highs. Part of that reason is because there is less optimism right now in the markets going into earnings. There is, I think people are concerned that the analysts are going to have some misses here. And what I'm talking about is the miss between their expectations and the actual are going to be wider because the analysts have had an easy time about it for the last several quarters. And the problem is that this 5%, 5.25%, this high interest rate, this high Fed funds rate, these high rates that we have right now, the cost to borrow money is much higher now than it was. It's been in a long time. And I think that's going to hit hard now with some companies, because some companies were able to kind of push forward. Here's an example. Some of you probably know cocoa prices are up like quadruple this year. The price of cocoa is up quadruple. How come Hershey's chocolate bars are still not 4 times as expensive? Because they have already made their purchases for the year. I mean, come on, have you tasted the stuff? It tastes a year old. And so, you know, they've got Hershey bars and chocolate in general. These companies buy futures contracts on cocoa. They're already locking in their cocoa prices into, for several months in the future. But next year, we may see chocolate bars and chocolate as a whole much more expensive than we see right now. But see, they were able to factor that in right now. And I think that a lot of stocks, a lot of companies were able to factor this information in, and they were able to pad themselves. And now we're starting to see companies that are projecting losses. We're starting to see companies that are laying off. Small companies. There are small companies that are shutting down, going out of business, that they made decisions. I'm not going to mention names, and there are a lot of private companies out there too. They made decisions on ramping up their business because of what happened with COVID, that V-shaped bottom and all that money was being flushed out in the consumer. And now the consumer doesn't have that money anymore. Savings have dwindled up. So now people are, and guess what? Credit cards are tapped out. So now the consumer, it's funny. I was watching earlier this week, I was watching a program on one of the financial networks. I'm not going to name who. Honestly, I can't even remember who it was. But they had the finance minister of Europe. I think that's who she was. And they were talking about the consumer in Europe versus the consumer in America. And they said, the consumer in Europe still has much of their savings left over, because they didn't spend it after COVID like the Americans did. Like those fat Americans. That's pretty much the way I heard it. That's not how she said it. That's the way I heard it. And so I looked at that, and she's right. She's absolutely right. When you look at the savings accounts and what's happened, all the savings have dwindled for the most part. So savings have gone down. Credit cards have gone up. They've reached their limits. A lot of credit card companies are not extending limits or adding to the limit on credit card purchases, because some of these credit card companies remember 2008. They remember 2009, and they remember what they had to do to get through those years. Those faceless, nameless people that had to deal with customers that were complaining that they needed their credit card limit extended after they'd already blown through everything. And those poor people that had to say no, it wasn't them. That person that's on the other end of that line, that's not their decision. That's somebody else's decision way up on top that doesn't have to talk to the customers. Anyway, again, I'm ADD and down a rabbit hole I don't need to go into. What's happening is there are a few people that remember those times, and they realize, that they've got some money they need to pad with. But that money's going to dry up too on the private side. All right, so here's some patterns. Here's some patterns for those of you that hung out and waited for me so long on this. What does Annaly Capital, Wolfspeed, Boeing, Boston Scientific, Meta Platforms, and Waste Management, what do these companies all have in common? There's 7 of them. All right, well, let's see. One is miscellaneous investing. That's Annaly Capital. Wolfspeed actually makes electronic components. We know what Boeing does. We know what they don't do either. We were supposed to fly this summer. Supposed to fly to New York a couple times, and my wife's trying to figure out, can we get on something other than a 737 Max? And I'm trying to figure out, well, we can get in the truck and we can drive north. Is there something else we can fly on? Okay, again, I'm going down the wrong road. Boeing, Boston Scientific, that's surgical and medical. I think we all know what Meta Platforms does, even though they call themselves a computer programming company. They're a social media company. That's where they make their money. And then they waste it all in things like Oculus and the metaverse. Waste management. We know what these guys do. They show up at my, at the end of my driveway twice a week. So none of those have anything in common. Aha, but they do. Let me tell you what they have in common. They all have earnings on the same day next week. That's not the only thing. You know what else is happening? These companies, I'm talking about investing, electrical, aircraft, surgical, computer, even sanitary services. They're all flashing sell signals heading into earnings because 3 of the last 4 quarters, they've all gone down into earnings. And the problem is, with the exception of maybe 1 or 2 of these companies, and I'm talking about Meta and Boeing, all the other ones, nobody's looking at. They all have gone down in the week heading up to earnings. They all are flashing sell signals. What's this to say about the rest of the market? So, I almost had another accident last week as end this week's podcast. Yeah, I was driving, I was driving my new truck, and it looks like it's a 3500. It's got those lights, those what are the lights they have on top of the cab lights, I guess they're called. So it looks like when I'm driving down the road or I'm coming in, it looks like I'm coming in to do construction work somewhere. Now, I like this vehicle because anytime I hitch something to the back of it, I barely feel it. I mean, it is meant to pull things. And I've been pulling around a few things here in the last few weeks. Anyway, I live outside of Sarasota. So what I've learned living here, especially the last couple of years with the influx of people coming in, we've got 2 types of drivers. We've got New Yorkers and we've got retirees. Now, that's a complete 180 when it comes to drivers. First of all, to you New Yorkers that are coming down here, don't New York my Florida, okay? What I mean is that, it used to be, there was no horn honking down here years and years ago. Now the horns go everywhere, and I've got to upgrade my horn because my horn's just not, when you honk your horn, 10 years ago, 15 years ago, when you honked your horn in Sarasota, I mean, people were, they knew something was going on. Something was wrong. Now, horn honks are like anything. It's like breathing. 2 types of drivers, New Yorkers and retirees. The first one, the New Yorkers, they got no patience at all. Apparently, they don't have turn signals either. But the second is retirees. Now, I tell you something. The retirees, they got no idea they're even in the car in some cases. But now we've got that third driver. That third driver is the one that I should have always been paying attention to. The New Yorkers, you could pay, they're offensive drivers. They're driving 90 miles an hour. They're swinging in and out of traffic, no turn signals at all. Then you've got the retiree just going so slow, you just want to get around them. You want to get around them because it's like they're driving. They as far as I know, they're driving their golf cart from the 9th hole to the 10th hole, and that's the speed they're going. But that third driver, that's the one that doesn't even realize they're in a car. Okay. I remember this, and excuse me for sounding sexist, but there were women that were in cars that, what they use that rear view mirror for? Not to see the car behind them, but to look at themselves in the mirror to make sure that their makeup was on. Some of them even did their makeup on the way to work or wherever they were going. Fast forward. Let's fast forward to now, because that was kind of like 80s, 90s. Fast forward to now, The car's being used as a mobile office or an entertainment area center. What I'm talking about is that more drivers pay more attention to their cell phones than they do what's going on around them. There is, I don't know the statistics, but I'm pretty sure that I can say this without a doubt, that accidents have gone up in value or up in numbers because of cell phone related accidents. And I mean, that does get people, it does, you're caught. If you get in an accident and you were on your phone, you're going to get caught, because what's going to end up happening is insurance company on the other side, lawyers on the other side are going to subpoena your phone records, and they're going to see the time of the accident. They're going to see what you were doing at the time of the accident, and you're caught. It's also no wonder that when you look at smart drivers today, what is it? 1 in every or 4 of every 10 cars, 40% of all cars on the road have some form of cameras recording their movements. Insurance companies, they have something called Snapshot now, where they raise your interest, your insurance rates, or drop them based on your driving habits, which I don't mind that. I think there's a little bit of a privacy issue there. I don't like, but I also don't mind the other side of that too. There's pluses and minuses to it. I mean, but the problem now is that there are more people texting while driving, and they're surfing while driving, and they're on their phones more instead of looking at what's going on. What in the world does this got to do with trading? That's probably what you're asking me. I gotta tell you this. So what did I say? My horn doesn't work like it used to anymore. I got a train horn. I actually got a set of Nathan air chimes. They come off of a train. I've had them sandblasted and repainted and basically restored. And I'm going to put them on the truck. And I'm going to use them. And so, I'm out there driving, and I see somebody on their phone more than they are looking at the road, and they're possibly causing a problem. I'm going to give them a blast. Well, the problem is that here's what's going to happen. Call me the Robin Hood of the road, saving pedestrians one at a time, especially if one's walking across the street and somebody's driving and not paying attention. I might say, maybe I saved that person. Are they going to thank me? No. I'm going to probably piss them off. I'm going to piss the driver off. I don't care about pissing the driver off. I can see it now. But officer, all I did was honk my horn at the driver who was texting to make them avoid hitting the woman crossing the street. I don't know why she had a heart attack. Seriously, though, think about this, folks, as I close this podcast up. Airline pilots fly thousands of hours before they get their pilot's license, before they can actually fly the friendly skies. Electricians, how many hours of apprenticeship that you have to do before you take your fingers and put them on the positive and the negative, before you wire someone's house, or before you're part of a commercial wire? How many hundreds of hours do you have to get to before you're considered an electrician? Surgeons, I mean, what is it? 4 years med school, 4 years residency, 4 years probably working under somebody. 12 years before you actually start, you begin as a surgeon. And I'm probably understating that. What about trading? How many years, how many thousands of hours do you have to do before you become a trader? 0. All you need is an account and some money, and you're a trader. And where I'm going with this is that there's no barrier to entry for traders. Is there no wonder that many people lose money trading? Because if you go back and you look, the typical novice trader that comes in and says, I want to trade, I want to buy options, I want to trade options because I heard they're cheaper than stock and you can make a lot of money from them, there's no wonder that person's gone inside of a year. They're gone. And there are certain times during the decade where you get this swelling of people that come and go. And we've seen that already. That was the meme traders. And that was all being funded by government money, which was being funded by taxpayer money. So where am I going with this? You know, many traders crash and burn because there's no barrier to entry. All right. So those of you listening to the podcast, listen to this. Let's all commit to continued education in this business, to continued experience in this business, to continuing bettering our craft as traders, and not just open an account, and not just put some money in it, and not just end up losing it quickly thereafter due to no experience. All right, folks, that's the podcast for the week. Thanks for hanging out and listening to me. I'll see you next week with another video. We'll talk then.